Hello everyone, welcome back to the channel. Recently, the world situation has become more tense than ever, with numerous conflict hotspots constantly appearing on the geopolitical map. Tensions in the Middle East, the risk of confrontation between superpowers, military attacks, and warnings from many countries are causing the whole world to closely monitor every development. And when war or the threat of war arises, not only governments and militaries must prepare, but global financial markets also react strongly. In this context, a very big question is being asked: when war breaks out, should investors hold gold or the US dollar? This is a seemingly simple question, but it relates to hundreds of years of financial history, because whenever the world falls into crisis, global capital tends to move away from risky assets to safer places. First, let's look at how the market reacts whenever geopolitical tensions escalate. Just news of a potential military conflict can cause stock markets around the world to plummet. Investors begin to worry that war could disrupt global trade, increase energy costs, and plunge the economy into recession. As fear spreads, money quickly flows into assets seen as safe havens. Throughout millennia of history, gold has always been a symbol of security during times of instability. From ancient times to the world wars, gold has consistently been considered an asset capable of preserving its value. When a country's currency depreciates or its financial system faces crises, gold maintains its value relatively stably. Therefore, during periods of geopolitical tension, the price of gold tends to rise sharply. There is a very important reason why gold is so trusted. Unlike paper money, gold cannot be printed by central banks. The natural supply of gold is quite limited, and the mining process is time-consuming and costly. This makes gold a scarce asset with lasting value. However, in the modern financial system, the US dollar plays a very special role. The US dollar is currently considered the world's largest reserve currency. The vast majority of international trade, especially oil, is priced in USD. Central banks around the world also hold large amounts of foreign exchange reserves in this currency. Therefore, whenever a crisis or war occurs, the demand for USD usually increases sharply. International investors, large corporations, and even governments tend to increase their USD reserves to ensure liquidity. This often causes the USD to appreciate in the early stages of a crisis. History has shown this many times. During the 2008 global financial crisis, although the crisis originated in the US, the USD still rose sharply due to global capital flows into safe haven US assets. Similarly, during periods of major geopolitical tension, the demand for USD often increases because the US financial market is considered the most liquid in the world. Interestingly, gold and the USD don't usually react in the same way during crises. In the early stages of a war, the USD often rises first because investors need cash and a strong currency for international transactions. However, if the war drags on and starts causing high inflation, soaring public debt, or declining confidence in the financial system, gold may begin to rise more sharply. In other words, the USD is often a short-term safe haven, while gold is a long-term value protector. Therefore, many large investors around the world don't choose just one. Instead, they diversify their assets across both to mitigate risk. Another crucial factor in the context of war is the price of oil. The Middle East supplies a large portion of the world's oil, and any conflict in the region could disrupt oil supplies. When oil prices rise sharply, global inflation can also increase. This, in turn, further impacts financial markets and prompts investors to seek safer assets. Furthermore, war can alter international trade flows, disrupt supply chains, and lead many countries to increase military spending. These factors can all affect the strength of currencies and financial markets. In today's world, with increasing geopolitical tensions, the question of whether to hold gold or the US dollar will continue to be debated extensively. But perhaps the most important thing is not choosing a single asset, but understanding how global capital flows react when crises occur. Because in a volatile world, a single geopolitical event can change financial markets in just hours. And for those who follow the global economy, understanding these movements is key to seeing major world changes before they actually happen. However, the story of gold and the US dollar during wartime doesn't end there. When we look deeper into how governments and central banks respond to crises, we see a much more complex picture. During wartime, countries often significantly increase military spending. This means governments spend more on weapons, logistics, troops, and defense operations. To finance these massive expenditures, many countries are forced to borrow or issue more money. This can sometimes lead to inflation in the economy. When inflation rises, the value of paper money can depreciate over time. This is why gold is often seen as a shield against inflation. When the purchasing power of money decreases, the price of gold tends to rise to reflect the devaluation of the currency. Meanwhile, the US dollar has a very special advantage over many other currencies in the world. The US possesses the largest and most liquid financial market globally. International investors can easily buy US government bonds, hold USD, or deposit money into the US financial system. This causes global capital to often flow into the US whenever the world becomes unstable. A prime example can be seen in many past crises. When war or financial crises occur, demand for US government bonds often increases sharply. Investors see this as one of the safest assets because the US government has a very high debt repayment capacity. When demand for bonds increases, demand for the USD also increases, causing the currency to strengthen. But this also raises an interesting question. Does war really always benefit the USD? In the short term, many crises do indeed cause the USD to appreciate because global capital seeks safety. However, if a war drags on too long and military costs become too high, the US economy could also come under pressure. Public debt could rise rapidly, budget deficits could increase, and inflation could emerge. In that case, the long-term strength of the US dollar could be tested. Furthermore, the world is currently witnessing major changes in the global financial system. Some countries are seeking to reduce their dependence on the US dollar in international trade. They are beginning to trade in other currencies or building new payment systems. If this trend continues for many years to come, the role of the USD in the global financial system may gradually change. However, at present, the US dollar remains central to the world economy. The size of the US economy, the strength of its financial markets, and the confidence of global investors still make the USD one of the most important currencies on the planet. In the context of the world facing numerous geopolitical tensions, investors are increasingly monitoring market fluctuations. A conflict in the Middle East could cause oil prices to surge. A financial crisis in a particular region could cause global capital flows to shift in just hours. And all of those factors can affect the price of gold, the strength of the USD, and global financial markets. Therefore, understanding the relationship between war, economics, and global money flows is not just a matter for financial experts. It is also crucial knowledge for anyone interested in the future of the world economy. The modern world is more interconnected than ever before. An event occurring in a distant region can quickly spread globally and impact markets in minutes. Therefore, monitoring geopolitical developments and understanding how they affect the economy is becoming an increasingly important skill in today's age. And the question of whether to hold gold or USD during wartime will likely continue to be debated for many years to come. But one thing is certain, whenever the world enters a period of instability, global capital flows will always seek out places where investors believe they can best protect their assets. In the channel's upcoming videos, we will continue to delve deeper into the stories behind global crises, from how war affects oil prices, to how stock markets react, and why the world's capital moves in such unique ways during times of instability. If you are interested in topics such as war, the global economy, geopolitics, and the secrets of global capital flows, be sure to subscribe to the channel so you don't miss the fascinating analyses in our upcoming videos.